Hi, I'm Andrew Kirsh, co-founder of Sklar Kirsh. On this podcast, I interview industry leaders. You'll hear their real-time opinions on today's market, their background, unique career highlights, and guidance for newcomers to the industry. This is the Kirsh Connection. Welcome to another edition of the Kirsh Connection. Now, typically August is a slow month in the transactional world where people are vacationing, ending their summers. But this summer, particularly this August, it's been very busy for us here at Sklar Kirsh. We just closed a portfolio of apartment buildings in the Pacific Northwest, another building in Atlanta, and several other deals that are slotted to close before Labor Day over the next several days. So we're expecting a robust fourth quarter of real estate transactions that will keep us busy until the end of the year. On this week's episode, I have Amachie Ackah, the co-founder of Clay Cove Capital, who's based in Philadelphia. Clay Cove is a real estate private equity company that invests in niche real estate opportunities. Things like art storage, preschools, alternative hospitality locations. And they're not just investing in the real estate, but they're making platform level investments in the company. I hope you enjoy my conversation with Amachie Ackah. Welcome to another edition of the Kirsh Connection. I'm here with my good friend, Amachie Ackah, the co-founder and chief investment officer of Clay Cove. Amachie, how you doing?
Doing well. How are you doing?
I'm doing great. I'm sitting in my studio here in West LA. Sad that we're not together in person. I saw you a few weeks ago at the beautiful Rittenhouse Hotel in Philadelphia. So I assume you're in Philly today.
I'm in Philadelphia, in my office here, which is Clay Cove Capital's headquarters, and wish I was with you in West LA. Love being out there, but we'll rectify that soon. I'll be out for a couple events, as you know, and hopefully you and I can have some downtime too.
Yeah, we'll have to get out to one of our great golf courses in the West LA region. So much to talk about. Why don't we first let's take a little high level snippet about Clay Cove, and then I want to get into where it all began for you. So, in case my listeners don't know about Clay Cove Capital, tell them, what do you guys do?
Oh, great. Well, I appreciate it. So Clay Cove Capital is a real estate private equity firm, but we focus on taking pre-institutionalized type of real estate and working with operators to build their businesses into a position where we can execute on those type of real estate assets. So we're not looking at the four basic food groups. We believe that there's tremendous value to be found by getting into asset classes that are really focused on how the consumer or the tenant or the guest experience is. Real estate's evolving that way, and so we focus on those trends and long-term dual demand, and we invest in the businesses that run those, and then the real estate comes with it. So it's a dual strategy between investing in growth for real estate dependent companies, but backed by real estate.
We a couple months ago we had Alex Valner on Center Capital here in LA, and what you're talking about with respect to Clay Cove reminds me of that conversation where he's looking to invest in businesses that end up having real estate, but really niche businesses, whether it's you know. Airports and airport hangars to other niche asset classes. So, what type of businesses have you invested in?
Yeah, so as I said before, we think of them as being pre-institutionalized. What we see is that there are trends in the market based on macro trends, based on consumer trends, based on work trends and how people live, work, and play. And we're seeing that the market sometimes is slower to respond to them, but there are great entrepreneurs out there who already have seen those trends, have built businesses on that, and we're in a position to help them grow their business. We've invested in areas like art storage. We have, significant assets in the Boston area, but growing outside of the Northeast, where we're seeing more and more activity in the art markets. We are working on early childhood education, and we'll talk a little bit more about that in a bit. But we think that's an area where there's a gap between uh, the lifestyle we see nowadays, where there's more and more, two income or even single parent families, and the need for childcare, and we invest in alternative hospitality. And when I say that, I'm talking about the fact that people are looking for experiences now, not just being in a standard, 450 square foot hotel room. They really want to be out there in destinations and build lifelong memories with their family, and focusing on the destination and the experience first, rather than just the building structure, is really one of the focal points of alternative hospitalities.
That's great. I mean, so many different verticals. We could do a podcast on each of them, but I want to be respectful of your time, and so we'll do it all in one podcast. But before we dive into a few of those specialty asset classes, let's talk about where it all began. Where'd you grow up?
I grew up in Philadelphia. I was, always born and raised here. I long-term Philly sports fan, but we'll get into that in another podcast. But I grew up my in King of Prussia, Pennsylvania, is where my mother moved out to, and the rest of my family was in West Philadelphia, and so um, really have deep roots here. I was lucky that I've also experienced other parts of the country through school and work, but this has really always been home for me.
No, it's fantastic. Look, we can talk about sports on this podcast because Philly and LA across really all sports, whether it's Rams, Eagles, Dodgers, Phillies, Lakers, Sixers. Gosh, Sixers now LeBron. That's what's the city like? Because when I was in Philly a couple of weeks ago, LeBron hadn't made his decision.
People were very happy. I think that it just like, listen, in sports, it's all about team. I think that LeBron's an incredible asset on the court and off the court, but I also think that there's a tremendous amount of talent in that dressing room and on the court there. And so I think people are really excited for the leadership LeBron can bring and the experience he can give to a group of incredible stars and backup players. So we're thinking that the team's in great position, and LeBron's a welcome and very, very exciting asset to bring to the.
Yeah, I mean, it could be one of the best times in Philly sports. The Eagles, I know they didn't win it this past year, but a couple years ago they won it, and Phillies always seem to be in it. Them or the Dodgers, and now Sixers. This is a good time to be a Philadelphia sports fan. Don't be so hard on your guys, Philly fans.
We do it out of love.
Okay, so after you graduate college and even business school, how'd you get into the real estate business?
Well, it's interesting. The question you asked before was really part of the deep-seated interest in real estate. I grew up in King of Prussia. The rest of my family was West Philadelphia. You can see the stark differences in sort of place. I started understanding and looking at the economics of place and realized that, real estate placemaking and real estate investing was really a driver of that. And it's been a goal of mine throughout college and business school. And so I was lucky enough to have great mentors. Uh, Peter Linneman, Joseph Jerko were Oscar Nakahara were my professors in business school, and have been lifelong friends ever since, and really gave me perspective. Joe Jerko got me my first job out of business school, working for the Palladium Group, Russ Appel and Floyd Lattin in New York. We were part of Credit Suisse First Boston, and I still am very close with Russ. And what he taught me was that Russ is one of the toughest guys in the business, as in tough internally. He is the nicest guy outwardly, but when it comes to adversity, and this business obviously has a lot of it. It's a cyclical business with a lot of capital on the line. Russ really had kept his cool all the way through, even when my associate training, my first month there was a merger between DLJ and Credit Suisse, and so all of a sudden our group had to leave because DLJ real estate partners were bigger and more established, and Russ took it as an opportunity. And I, to this day, watching him, through the glass walls of conference rooms in his office, seeing how he just methodically went through what could have been a crisis and made it a huge opportunity has always, been something that's an impression on me. He has a, stomach of steel, and it's needed in the business world because you can really turn around these situations and create tremendous value from that. And that's really always been a foundation of how I approach business.
Yeah, I mean, look, every hard time, every recession, there are clients of mine who view it as an opportunity. I guess the question for you, Amici, is taking your mentor's approach. How have you implemented that yourself over 25 years in business?
Yeah, I think that part of it is that when we look at these opportunities for these real estate dependent businesses, and these are tremendous entrepreneurs who built businesses, at a small scale. We see growth and opportunity in them. So we're not saying just looking for the shiny new object. We're looking for that hidden gem of operators who really can partner with us. And when we provide them with a real estate strategy, we're looking for ways to be innovative and looking at real estate that may not be utilized optimally, but can be bought at a low cost basis and turned into tremendous assets for their business plan. So, turning obsolete industrial into art storage, turning closed pharmacies into early childhood education centers, taking campgrounds that have closed because of the change in how kids spend their summer, turning them into an alternative hospitality resorts. Those are kind of things that we take what could be a crisis and make it into a tremendous asset. Looking at a low cost basis that can provide tremendous margin for our investment platforms and then returns for our investors.
So those are very unique ways to use real estate, from art storage to you know pre-kindergarten, preschool, educational facilities. How did you guys decide to go all in on those businesses and others?
There's a process, right? Our team looks at the market and looks at trends, long-term trends. We view it as is sort of super tankers moving, but you got to recognize that it's moving. And if demographics are changing and trends are changing, we try to do tremendous research to understand those and then uh, see where they map to how real estate provides solutions for those, right? How real estate houses those. And we see businesses that really can be um, capitalized to be part of that long duration demand. And that demand chain we're looking at all constantly to see, is this a business plan that has real legs, that can grow over time, and can be in a position that can produce returns for investors, as well as create tremendous enterprise value for the operators the lifeblood of our business is working with great operators who are in these businesses. So there's a process that our team has. We have uh, you know, a tremendously strong team that looks at different aspects of the business, including a strategy and research group that really spends all their time exploring these trends and how they're overlaid into real estate strategies.
So are you investing in these companies? Are you investing in the real estate? Is it all of the above? I guess if you could walk me through an example, you could take the specialty storage, the art storage. Is Clay Cove taking an ownership interest in the actual uh, operating business itself, in addition to the real estate?
Yes. So what we want to do is we make sure there's alignment of interest. And as these operators who we've developed relationships with over several years, sometimes decades, are growing their business, they're looking for partnership on both their business and their real estate. And so we will invest in their business with them, be a partner. Yeah, we set up all the right governance that's best in class to grow a business. And often that's growth capital, very standard. It pales in comparison to the need for real estate because they're real estate dependent businesses, right? If you're in a storage business, whether it's self storage, art storage, cold storage, you have to grow by getting more facilities. And so having a real estate strategy for them and providing the capital for them to expand is critical. So a combination of investing in their platform, which is symbiotic with their real estate. They are the managers of our properties. So it's not kind of out there, oh my God, we're investing in the operating company. We're investing in a management company for our real estate that happens to provide other services that are needed in the market that have tremendous demand over the long term. And we think that is a way to align interests, to create synergies, and to build value on both sides that our investors can benefit from.
When did you start Clay Cove?
You're making me reveal my age. Uh, so we started Clay Cove in 2013. My partner Brian Ang is one of my best friends from college. We met the first day of college.
Wow.
So we've been, uh, you know, in obviously very close relationship for decades. His family and I've helped with their real estate investing over the decades because they've had tremendous assets in New York and other markets. And we came to a point, after the great financial crisis, 5 years had passed by, and we really saw were opportunities that weren't being taken advantage of in the market. And so Brian and I started with us and built a team that's looked at this kind of strategies that we've evolved into, and have done this now for almost 15 years, and really just couldn't be prouder of the team we've developed and the processes we put in place and the relationships we built with both operating partners and limited partners.
So when you are, well, let me ask it in a more open-ended question. In addition to Brian and his family that you were initially helping, uh, do you guys have outside capital that invests in Clay Cove?
So all of our investments, our funds and direct investments, are with limited partners. I use the word partner because we really do believe that our limited partners bring us more than just capital. They have tremendous perspectives in their experiences. A lot of them, whether it's family offices, universities, foundations, uh, they have the same entrepreneurial background somewhere in this space as us. How the capital was created from an entrepreneurial background. They have tremendous insights into different parts of the market. So we really believe this is a ecosystem of partnership, and we've been blessed to have long-term relationships with uh, investors and limited partners who have invested pretty much continuously in all of our investments, and we continue to grow that network.
And how was it when you were first, when you first formed Clay Cove, and your thesis, assuming your thesis, close to 15 years ago, is similar to what it is today, and in partnering with operating businesses and investing in operating businesses where real estate is fundamental into the success of these businesses. But as you alluded to, or directly indicated at the beginning of the podcast, you're not investing in traditional multifamily and office and industrial and retail, but it's these businesses who have a specialty use. When you were going out and raising capital, what was the feedback that you were getting from your investor community?
Well, I think that when you really break it down simply, and you're saying we are working to look at areas that we see tremendous growth in, and we're looking for the best in class, smaller mid-market operators to grow that thesis with. People really understand that. I think it's the entrepreneurial nature, the innovation that comes with it that people are attracted to. And so and again, this is also the same thing with looking at new operators. We're looking for people who really embrace that. And we do that same thing for our team members. Our team members all were entrepreneurs. One thing we look for when we're hiring people is like, have you started something yourself? And so when you look at that and say you can apply that to real assets, that you can benefit from innovation, but backed by real estate, people really get excited. saying, this is a great way to grow my business. For operators, one thing that we look at to them is that, hey, you want to get to market quickly. But look at the fact that if you can own your real estate with a partner, isn't that better than leasing? Right? You can turn a liability into an asset, and that can be part of your enterprise value. When they see that, they're really excited and they believe in their business and they know that they have a great business plan and it's backed by strong demand. Why not find a partnership where you can actually own the whole ecosystem? So it's something that our limited partners embrace. Us as a general partner really obviously have dedicated our time and efforts to it and our careers to it, and our you know our operating partners and limited partners are aligned with us.
And how do you find them, these operating partners?
Yeah, well, it's a process. We look to continue to build relationships through the industry. All of our team is really engaged in industry thought leadership. They are reaching out to people in different ways through going to certain events, trying to, we're big people in the ULI. We're obviously involved in YPO, uh, in PRIA, all these areas where we're building communities. And these communities are based on people who speak the same language, and are looking for ways to make this business more innovative and change the real estate landscape, all for the betterment. And our view is that we want people who say the customer comes first. They're changing in their needs. Real estate can be slow and methodical, but it still doesn't mean it can't be innovative. And we have to answer the demands of the customer, of the tenant, the guest, whatever it is. And so we're looking for people who have that type of view of how can it be different that match what the market's asking for, rather than just doing the same old thing because that's easy.
And for an operator who's in these um, businesses that are interesting to you, and the thesis that you're trying to um, advance, how mature of a company do they need to be? How much revenue? How big? Employees? Size? What are the metrics, the objective metrics that someone needs to obtain before they can partner with Clay Cove?
It's a great question. So again, we try to be as entrepreneurial and innovative as they are. I think there's certain basic fundamentals that we're looking for. We want to have someone who's managed multiple locations. That's one of the hardest things in business, right? You have a business, it's real estate dependent. You are successful. You built one property, but to go from one to two to three, it starts talking about distributed teams. You putting in systems in place, and you have to be willing to do that before you can be in a position where you can think about growing out a platform. So that's really what we're looking for. We Businesses change. We're not looking for exactly a number of employees or a certain level of revenue. Obviously, we want something that can pay the rent, right? So we believe that we're investing in the business that we're not just the rent collectors. We're building the business that pays the rent, and with that, there has to be a certain level of stability there. But we're also looking for them to be in their growth stage. So it's pretty early, but it's in a position where they've established a business that's multi-unit, that's working well, that really is looking for a growth path to establish themselves into that value chain, that demand chain that they've proven out exists. And so that can be relatively early where we can get tremendous value, but it is based on a stable business that's ready in all ways for growth.
Mhm. Do you feel like the businesses that you are investing in and partnering with, Is it also location specific, or is it really location agnostic? And I asked this question. We have a lot of multifamily owner operators on this podcast, and the last couple of years, those that have gone deep into the Sun Belt, they're hurting, right? The oversupply and rent concessions, and those that have invested in coastal markets also are having some issues because of, political issues and with the multifamily business, and it's tough to build, and it's tough to add increase rents in those markets, and so there's always these headwinds depending on geographically where you are transacting. What about with respect to the businesses that you're in?
So that's interesting. I think we'll give you, a couple concrete examples and stuff that we've talked about, right? When we look at art storage, there has been a heavy concentration in the Northeast for obvious reasons. That's where most of the museums originally were. That's where a lot of the universities have big collections are. It's a lot of collectors were. What we've seen over the last several decades is that there's been a massive proliferation of wealth being created in markets in California, in Texas, and south parts of the Southeast, in the Pacific Northwest, where we're seeing opportunity. So we look at a geographic overlay to how we build a business plan and say, okay, we already have a beachhead in the Northeast. It's an established market. Where can we really see growth potential? And so we're seeing it in these areas where wealth's happening. So people collect art, and it winds up that it gets given to museums, universities, institutions, all of them needing storage. We also see the same thing in a geographic footprint and business plan on early child education, right? Some people say, "Hey, there's lower birth rates. What's going on with children?" But we're in markets in sort of the Southwest and in the southern parts of California. You're seeing tremendous in migration, higher birth rates. You're seeing job growth in those markets. There is no lack of supply of children in those markets. So we look at um, parts of Texas, Utah, around Salt Lake City, San Diego and Orange County, uh, around Phoenix, Arizona, Las Vegas, Nevada. Those are all markets where we're seeing tremendous growth. So that's where it's more of a regional business plan rather than just a national business plan for us. Uh, and in alternative hospitality, we're looking at a combination of areas where we're seeing great opportunities for great destinations for people that have vacations or for companies that have retreats. But we're also looking for markets where there's the seasonality is sort of muted by having three high seasons out of four, and that allows us to have more durability for our annual revenue. And also, utilize our staff in a more distributed way. So those are the type of things that we put into our research and our business plans to make sure that we have something that the geography matches the business plan and gives us the best competitive advantage.
So what about political policy, government policy of today's you know White House administration, from their immigration policy? Does that concern you with respect to uh, the childcare business? If there's declining population, and similarly with travel, unless if you're assuming that most of your uh, travel guests are local or domestic as opposed to international. Um, so I guess it's a broad way of saying, how focused are you on government policy to the how it affects your businesses and the real estate that you guys own?
So we're always looking at the macro picture. We're very focused on doing the type of fundamental research and analysis to understand where the macro picture is driving the drivers behind real estate and demand. To answer your question specifically on ones you're talking about, uh, listen, we understand that we have a tight labor market and that we're experiencing less and less supply in that labor market. And with that, we think that we want to put ourselves in a position so that um, we can take advantage of those inflationary pressures rather than be subject to those, and that we apply those to all of our strategies. Something that's labor intensive, like alternative hospitality, what we look at as operating leverage, and that's the ratio between fixed costs to variable costs. And the great thing about alternative hospitality is that generally the type of strategies, whether it's cabins or glamping or RV parks, you have variable costs based on your occupancy. The challenge with traditional hospitality is that in a resort, no matter whether you're at 100% occupancy or 70% occupancy, we still have all the cooks, all the porters, everyone else. It's an extremely high fixed cost. And so that we call operating leverage, where we can actually lower our fixed and higher and adjust our variable costs so that our more efficient operating model can create greater margins for our investors. Um, when we look at other policies that you talked about, you know, you know, when we see situations where, um, you know, there might be some different policies depending on the regions of universal pre-K or less pre-K. What we see is an opportunity set in the areas where they're introducing more and more public versions of pre-K. We think that's great. People should be focused on the fact that those early years are the most impactful time for investing in education. That's the foundation for everything else that comes after it. And so, when those areas that are looking at public subsidy for early child education, we see an opportunity set. And we hope that our product is so good that parents will pay for what we think will be the best environment and the best education for their kids. So we don't see that as an issue. But where there are areas that are divesting from that, and municipalities don't even have full day kindergarten, we clearly provide a service that's needed. So those are things we look at, and we try to find ways that we can be value added in the ecosystem.
One of my first deals as a young associate at Latham and Watkins involved kinder care and the Milken family office purchasing kinder care, and their, gosh, I don't know, close to 1,000 locations. Could have been more, could have been 2,000 locations. And tried being a junior real estate attorney on a portfolio of thousands of early childhood care facilities. I definitely learned a lot on that transaction, and they still own it today. 20 plus years. The Milken family office owns KinderCare.
We've seen some of these innovative family offices be very early in some of these trends, and uh, obviously it bodes well. As we say, it might be pre-institutionalized, right? The pension funds, others haven't got into it, but others have seen the value, and that gives us a lot of confidence in some of these strategies that there's real legs, and that we can bring them to our investors, who some of them are institutions, and really want to see that there's a group that they have relationships with and trust that can help pave the way to get to the point where they have higher margins because they are, you know, earlier into these type of assets than the rest of the market is.
Yeah. All right. Speak to this fact pattern that I'm seeing play out almost daily as where you sit from an institutional capital allocator. And I know you don't allocate capital to the major four food groups without there being some niche, real estate niche operating business. But the frustration sort of goes like this from an operator partner. They see an opportunity, whether it's multi or industrial or office or retail, and it's a large enough deal where they can't syndicate it, and they want to partner with an institutional real estate private equity company, and that private equity company tells them, they're looking for at least, let's call it an 18 or a 20 project level IRR in order to do the deal, and the operator say, look, guys, the only way we're going to be able to deliver that type of yield is we either need to go into a market that you're probably not going to want to go into, or buy a vintage that is probably too old for you, or to do a heavy lift that you may not seem interested in. And there's just frustration, and they end up not doing the deal. I have these conversations constantly that operators perceive or say that the return expectations or the return requirements of real estate private equity is not in line with where real estate is trading today.
Well, I think that's true, particularly when you talk about the four basic food groups. It's hard because they have been institutionalized. And so that there's tremendous capital that has invested in them, has built out infrastructure and built out a uh, capital ecosystem where naturally, as it becomes more and more institutionalized, the return expectations have to become compressed. That's part of the reason that we're investing in ones that are not institutionalized. I think that there's also, though, innovation and maturation of the capital markets where there is capital for every type of return. I generally see that there's not dumb money. There's money that has different return thresholds because they have different needs, and whether it's uh, certain areas that they just need a 4% because they're looking to keep their capital base just above inflation and grow it, or there's groups that need opportunistic type of returns. What we do to answer that need for opportunistic returns is that look at both the real estate and the operating company, build platforms that get to a certain scale and scope that create tremendous value, right? When you have a portfolio, generally portfolios, their cap rates are slightly lower than just one-off assets. When you build a operator who is managing a huge or substantial portfolio of assets, their EBITDA multiple goes up because of their scale and scope. They have the ability to be more efficient, to drive unit economics, to build network effects. And so putting those all together is complex, but we have a team that really has a great experience in this and learns how to work with our partners to fill out those business plans, and therefore be able to achieve optimistic returns by looking at all sides of the ecosystem: the assets, the business, the operator, and looking at ways that we can make those all valuable and create enterprise value that can be monetized by our investors. And more importantly, monetized by the operator. So I understand the frustration that's out there. I believe that in the areas we're looking at, the operators that we're working with understand, and the operators that we talk to, that if we're patient, you have the right partner in us, that we can get to a point over the long term that we can create tremendous value. Is it 100% based on IRR? No. We look at the patience to make sure that we are building equity multiple and making sure that we are growing capital base. And so some will be IRR that's higher than we ever thought because we've had business plans where we sold a portfolio when it wasn't even completed. And others will take a long time, and they'll be in a situation where we're partners for 10, 12 years. We may not have that astronomical IRR you're talking about. We'll have a very strong one, well above obviously a spread over any type of index that we're comparing ourselves to or benchmarking ourselves to. But the equity multiple is tremendous, and our limited partners and our operating partners tremendous, really tremendously respect and appreciate that in our business plans, because the equity multiple on their capital is what they can spend, and so we're really focused on that too.
Is there a concern of the future of, I guess, the business that you're in, sort of broadly of equity allocators, that there is a sense of trying to circumvent the double promote structure, and that LPs, endowments, pension funds, institutional investors will match up directly with end users of real estate in terms of owners of real estate or the types of companies that you partner with?
Well, listen, as things get institutionalized, I think that it's the natural progression that sophisticated institutional capital can go directly to them, right? The business plan's been proven out. We've created the entire metrics that people don't look that people need to make those direct investments and do it over and over again. But when it's pre-institutionalized, that's harder. Simple things like art storage. I mean, no one knows what the standard is for circulation and that percentage of loss in the building. We're working very hard to understand that efficiency and build that out. Does the kind of work that our team does that is part of the evolution of any type of asset that comes to market in the real estate market. You've got to do a lot of work to understand that. And the difference is that we can do that in the middle market because we're dealing with capital at scale and scope that we can take that time and research. When you're looking as an institution to put out massive amounts of capital at one time, because you need to, nothing wrong with that. I mean, that is their mandate. It is hard to institutionalize an asset class then because you're looking to put out the capital, get it to work in institutionalized assets that are formulaic. And that's great because you need a certain return. So I think that where we are in the business, we're in a position where we're insulated. We have a moat around us because we are doing the exact work that in the value chain the institutions need us to do to get to the point where I hope art storage is the next self storage. Where 25 years ago, and again, I'm telling my age. Don't tell anyone.
I think we're the same age.
I know. I'm not ratting you out either. I'm not ratting you. But 25 years ago, that was all pre-institutional. Moms and pops, they owned a facility on the corner, of a warehouse district, and people are like, "Oh, someone go store stuff there." And in that 25 years since, it's become a business that is robust. Private capital's in it. There are REITs. You know, there are institutions and pension funds that invest directly and build because it's all done the work that we do. It's been done over those decades, and that's where we are within the value chain, and we think that's always going to be a safe space to be. It takes a lot of research that uh, others may not have the time to do,
Yeah.
and we create that space to do that because of looking in the lower middle market and being able to build these relationships with these operators, build these business plans over time, and really build out that type of institutionalization of the asset.
All right. Two final questions for you, Amachie. I know I want to be respectful of your time.
A great time. Having a great time. Take your ask away.
Perfect. We met each other through YPO. I've had YPOers on my show, especially ones like Sandy Siegel, who spends so much time on YPO. And I asked him, how I feel like there are 24 hours in a day for most people, but for you, Sandy, I feel like it's 48 hours in one day because of how much you get done. I'm going to ask the same question for you, Amachie, because I don't, other than Sandy, and I think maybe even more than Sandy now, you are involved in so many different organizations, and specifically to YPO. I see you creating the Harvard real estate YPO program. I see you traveling all over the world, whether it's Asia or the Middle East or Africa or Europe. You're constantly traveling for YPO, it seems like. How do you have time to be involved in? I'm sure you're involved in so many other organizations. So, from time management, how do you get it all done and still have such a and your family, successful company?
Well, YPO is about lifelong learning, which I think is essential to not being obsolete. And not only that, on the positive side, it's a fuel for innovation and making great businesses. So I'm fortunate enough that all those things you've mentioned, creating the with Sandy. So Sandy and Carlos
Hmm.
Menico, we built the YPO Harvard Real Estate Program together, going to different markets and understanding them. They're all contributing to my business. It really helps. And my partner Brian does the same thing. He's on boards. He's involved with a lot of different things that all comes back every week to the firm, and we share. And other members of our team are doing the same type of work and share with each other and are learning from each other and building a better ecosystem of knowledge that we can share with operators that can make their businesses better. So all those things that and I'm honored that you have such a high esteem for me that you would put me in the same category as Sandy Siegel, who again is such a friend and mentor. Those are for us parts of our business. They are lockstep in how we approach these markets and build processes and approach how we can really build a business that looks to take assets that maybe people don't love and turn them into valuable assets, see opportunities where others don't see it, uh, help great businesses that we know have a long-term durable demand, make a business plan that achieves that. That's what I learned from being involved in a great organization like YPO, being on the board of the Philadelphia Museum of Art. Obviously, that helps with art storage. Uh, you know, being on school boards helps with early childhood education. All of that is invaluable knowledge that we can bring to the benefit of our operating partners and our limited partners. And they take that and give us feedback. And we can constantly, it's a constant model of reinforcement, lifelong learning, and peer exchange of ideas that allows us to execute on some of these complex transactions that we work on. So building platforms, it's a lot of fun, but it's even more fun when you can do it because you're taking deep understanding of some of the complexities and opportunities because you've met peers that have given you insights that you could get nowhere else.
We are old enough to be asked for advice, and so I will ask you this final question. When a 22-year-old grad says, Amachie, I want to get into the real estate business, but there's so many aspects of the real estate business, from the operator side to the capital side to the brokerage side. Where should I start my career? What would you tell them?
Well, I think it really ties to what we were just talking about. Um, I think that always be curious. You don't necessarily have to be on one path, right? Some people say, "Well, what's the silver bullet? How can I be in a position where I'm going to be, uh, you know, running a real estate private equity firm, or I'm going to be this?" I think the path is part of the education. And even before then, I tell people you don't have to specialize your first year in college. If you want to, because you just know what you want to do, that's great. But if you don't know, take the time to learn. Just try to go out and be a musician who you are a person who learns how to learn, and that can make you a tremendous value within the industry. So be that generalist, learn to learn, be curious, look at other peers and try see how you can learn from them, and that's going to help you with the ability to be innovative and create yourself, create opportunities for yourself, and build yourself a career path that's going to be based on what you love to do and takes your best skill sets. So I'm always looking for people who are you know, really curious, are constantly in a position where they're doing what we were talking about before, taking experiences and really interpreting them, making them all putting them all together into a mosaic of knowledge that really looks different each time and each challenge that you face, and taking what could be a real, what some people would say a real challenge, and making an opportunity.
No, I love it. Really insightful, thoughtful words, Amici. When I see you in October, it'll be what, maybe third week of October. I think by that point, hey, the Dodgers and the Phillies may be in the NLCS at that point. And I think we are going to need to have a wager where the loser will have to wear the other team's jersey at this conference.
Well,
You won't be able to wear that beautiful suit. You're going to have to put on a Dodger jersey, maybe a Shohei jersey. And
well, I can put. I mean, the Phillies are going to win, but
then I would have to wear a Harper jersey or a Schwarber jersey. Deal?
you can choose. You can choose your favorite player from the Phillies. I've got a few of the Dodgers. I have tremendous admiration for what the Dodgers have built, and they're fun to watch. But my Phillies, they have what is intangible. We have grit, and
Yes, they do.
and that's what Philly's all about. So yeah, I'll take that wager, and may the best team win.
I love that. Well, I can't wait to see you. I truly appreciate you coming onto the show. Very insightful conversation, as I knew you would, Amachie. So thank you.
Well, Andrew, you've always just been such a gentleman and a great friend, and it's always great to sit down with you, no matter what the circumstances are. So, look forward to seeing you in October, and happy to be on the show anytime. Or again, I'm just one member of the team here. So, my partner Brian, my other partners, we consider all of my team, from the newest person to the oldest person, which happens to be me. All of us are partners together, and I think there's a tremendous wealth of knowledge here. So it's not me. I'm fortunate to have the people I work together with every day. So happy to represent them and represent my operating partners and limited partners. But thank you for having us.
Absolutely. Well said. Thanks for coming on. And that is another edition of the Kirsh Connection.